great time to raise capital, but be careful in how you spend that capital. In every year, there is a summer, but there is also a rainy season, there is also a winter. It is going to happen, whether you like it or not. And make sure that you are planning those scenarios as you spend your capital.
Hello and welcome to the Startup Operator Podcast. I'm Roshan Cariappa. My guest today is Alok Goyal of Stellaris Venture Partners. Alok has been investing for almost a decade now and has seen the evolution of the Indian startup ecosystem up close. He was one of the earliest believers in the India SaaS story, having invested in companies like Whatfix, Signsy and Slintel. In this conversation, we spoke about fundraising, venture capital, startups and SaaS. This was a fun conversation, a lot of insights in here. So let's get into this episode of the Startup Operator Podcast with Alok Goyal. Hey Alok, welcome to the Startup Operator Podcast. Thank you so much for making the time.
Thank you so much, Roshan. Pleasure to be here.
Yeah, so I've really been looking forward to this conversation. You've been in VC for a good amount of time, and I'd love to know, plenty of things on how the startup ecosystem has evolved, how you're seeing the market right now, and how you see the future. So maybe a good place to start is with some opening comments on the record fundraising that we've seen this year, right? I mean, in Q3 itself, I think something like $10.9 billion across 300 plus deals and so on. So there's a lot of unbridled optimism in the market right now. So what are your thoughts on this?
So Roshan, if we sort of take out the emotion from the numbers a little bit here, I think the most significant part of 2021 was what I would call in the startup language that I think the Indian venture ecosystem or the Indian startup ecosystem has proven its product market fit. Because if you think of the cycle of building startups, it takes 8 to 10 years to build a real company. I think building anything good, in my opinion, takes a decade. There is some flash in the pan, but by and large it takes. So if you look at 2006 to 2008 cycle, was a time when most of the mature pack of funds started. Companies got funded in that first set of cycles. Many of those companies have matured. And we have seen exits happen this year, whether it's Paytm, whether it's Latent View recently. Lots of different companies have exited, gone to IPO, been acquired. In our portfolio also, for example, Slintel got acquired this year. It shows that there is a product market fit for Indian startups. There is value to be created. There's value to be captured. So I think that's the most significant event for this year. I also think that we are seeing sort of the third wave of the startup ecosystem in many ways. We saw the era when there was no money. Yes, there was a Chris Cap, there was ICICI Venture. If you look at companies that started in the 90s, up to the mid 2000s, there was very little capital available. Over the weekend, I was with Hitesh Oberoi of Naukri, and he was walking through his entire story. There was no money to be had in that time, right? Very little, right? These guys have built that. There is a next era where there was money, there were funds. These were mostly first generation entrepreneurs in the sense that everybody was starting from scratch. Internet penetration in India was still growing. A lot of the underlying infrastructure was not available. If you look at the 3.0, I think we are finding ourselves in a place where there is capital availability, there is availability of expertise, there is a fair amount of success that has already gone in. And there is therefore every reason that with the proving of this product market fit, a lot of capital in the country is coming. I think people are recognizing that venture can be successful in India, and capital is one thing, Roshan, that moves the fastest. Yeah. If you think about what has the highest velocity of anything, labor and talent actually is very slow, but what moves the fastest is capital. Yeah. Where you see opportunity, capital moves there. That being said, I think we should also be careful on what all we deduce from this fundraising cycle. I think it is also a sign of a bull cycle, whether we like it or not, whether we admit it or not, there is a bull cycle going on. And we should also recognize that they don't last forever. There is a saying that life is never as bad as it looks. It is never as good as it looks. And I think we are in that situation where I should say that it is not as good as it looks either. It is a result of excessive liquidity in the market. And it's not just India, I think it's globally. It is also not just the liquidity. Money can go into multiple asset classes. I think people are realizing that both in debt and public equity, people think that in the next decade, the returns might not be as good as what they have been in the last decade. And therefore, we are seeing a disproportionate amount of money going to private assets and technology in particular, which is driven by COVID. I think people are seeing the tailwind COVID has provided. So all of that has resulted in this record fundraising that has happened in 2022. We have seen, I lose the count whether it's 35, 36, 37, how many new unicorns have been created in the country in this year. But I think all of that, even though I would say that, look, we should always be slightly cautious also, but I think 2022 has been a very encouraging year for the Indian startup ecosystem.
Yeah, no, you put it perfectly. Actually, it's the confluence of variety of things coming together at the right time. While we remain optimistic about this, right? Is there some cause for concern as well, because you're seeing crazy valuations, you're seeing ideas being funded almost, right? So, if I'm an entrepreneur who's looking to raise capital at this point of time, what are some things that I have to be careful about?
I would say that, look, it is important as an entrepreneur. See, I think entrepreneurs need to be opportunistic as well. Like everything else, when you're building a company, you're constantly thinking how to differentiate your offering in the marketplace. You're also thinking, how do I get the best talent? But one of the jobs that the entrepreneurs do, or CEOs or the founders, is that they need to de-risk the company from a capital perspective, always. And not every window in the market is equally good to raise capital. So I think my advice would be twofold to entrepreneurs in this cycle. One, they should actually raise capital. This may not last. At the same time, they need to make sure that they're being very judicious in spending that, because the party also doesn't last forever. You burn very highly. Let's say you just dramatically increase your marketing burn because you think lots of capital is available. I think you might hit the wall in 18 months for all you know. So as I said, both go hand in hand. Raise the capital, but be judicious in the way you spend the money.
Right. And speaking of fundraising, I mean, you guys also raised your fund, right? I mean, 225 million, which is like a huge bump up from the last fund, which was around 90 million. What was that experience like? And also, what is it like raising, cash in this remote era, basically? So was it a lot of Zoom calls and so on?
Yeah, Roshan, the interesting thing is, when we thought about raising the fund, we thought about it initially that we were going to hit the market in February, March last. And as we had booked our tickets to US and we canceled it. I remember that I was going to take a flight on 13th of March last. And of course, we canceled the flight. That's when just lockdowns were starting here in the US. And we assumed the worst at that point. Fast forward 6-7 months is when we realized that the market is beginning to open up. And in many ways, even we didn't expect the fundraise market to be as good as it turned out to be. So I think, as I said earlier, also the demand for this asset class has gone up globally. Demand for VC has gone up. And I'm saying from an LP perspective, demand for India has also gone up overall. And both of that actually helped us. Clearly, we also benefited from the fact that our first fund has performed very well. We were lucky to have backed some great entrepreneurs that clearly helped. But we can almost divide our fundraise into two parts. Initial part was still a bit slow when we started out. And then it's almost like everything came together suddenly and it just shot up. I think what helped us particularly, Roshan, is the fact that all our existing LPs, not only did they come back in for second fund, they actually put up larger amounts from what they had put in the previous funds, their previous fund. And once the existing LPs showed so much confidence, it was actually relatively easy to go to other LPs. What also helped a lot, I think, which is what you pointed out, is the fact that we were doing all of this activity purely on Zoom. When in the earlier world, when you had to meet an LP, let's say somebody is in Singapore or Hong Kong or London or US, expectation always is that you will go and meet. Imagine for one meeting, all the travel you do, one slot you get, etc., etc. And by the time you do the next meeting, it might be 4 more months. Because it's on Zoom, everybody has time. Yeah. So I think just this fundraise cycle being on Zoom actually turned out to be a boon in hindsight for us. So we ended up raising 80% of our capital from outside the country, and 80% of our capital also came from institutions this time. But what was particularly heartening for us, and I think which is also a sign of the times and how startup landscape has changed, is that I think one of the most important constituents of the startup ecosystem in India are actually successful founders. Look at the founders of Big Basket, founders of Capillary, founders of Blackbug, Mintra founders, lots of these founders. I think all these people are becoming very important because they all have a paid forward kind of mentality. They are the first ones that entrepreneurs approach. And it was a design principle in our first fund, and which only got amplified in our second fund, that we wanted to make sure that we have some of the most successful entrepreneurs in India as LPs in our fund, which we refer to as the founder network members. And they are very well integrated in our life cycle. So 20% of our capital actually came from this group this time as well. And yeah, overall, we are very fortunate that people backed us this time. It, of course, ups the ante. We have taken somebody's capital. We have to deliver on it. And while the first fund has done well, we need to make sure that we up our game to give the returns that our LPs expect from us in the second fund as well.
Right. Yeah. Some of the second order effects of having some successful entrepreneurs and even, early members and so on is real, right? I mean, we're seeing with the amount of angel activity, for example, operator VCs and so on coming into the ecosystem. Since the time you joined the VC business in 2013 with Helion, right, much has changed, right? I mean, the last 8-9 years. How have you seen that evolution? I mean, it seems like plenty of different structures have evolved, plenty of different people have come in, institutions don't look the same these days, right? So how do you see that all together?
I think in many, many ways, the ecosystem has matured a lot. And I'll give you many examples behind it, what I mean by maturity. Let's first talk about the capital supply side for a minute. I remember that when I joined the VC business, there were probably about 7-8 funds. And there were no seed funds practically. There were 1 or 2, but very small vehicles. There weren't any Series B funds either. There weren't really any Series C funds in India as well. You still had to go to a Tiger or a SoftBank or someone and rely on. And therefore, those who wrote Series A had to write Series B. That's how we all used to think in terms of follow-on capital as well, because we knew that we'll have to have the capital. I mean, we need to have the dry powder to be able to back these companies. Yeah. Today, however, not only have the number of funds gone up, but they are coming across every spectrum. There are people with $10 million funds that are writing 100K checks. There are people with $30 million funds that are writing 500K checks. There are people with $100 million funds. There are people with our size. There are people ahead of us. There are people who are writing growth. There are people who are writing only B and C checks. Some writing D checks. So I think there is that availability of capital, which has become more specialized by stages. When we are writing a check, we are not thinking about that we will have to write the next check. We know that there are plenty of people coming next to us who will write the next check. Also, I think for entrepreneurs, there are more sources of capital, and therefore that choice has gone up for them significantly. I think that has also meant that the terms in the market have become more equitable for founders. And I have no hesitation in saying this, that if I look back 8-9 years back, I think we were in a capital starved market. I think we are in a situation today that the terms are therefore a lot more equitable for founders because they have choices, and which is the right way. Ultimately, they are the ones creating value. And I think, just take an example. If it's a very small round, there were times when Indian founders will dilute 25-30%, even for a tiny amount of capital. Today, that will be a convertible note. It will be a safe round. They don't dilute in that round. So I think those kinds of things have changed. What we're also seeing, Roshan, is that there are a lot of sector specific. On one hand, you see DSG, Fireside, Sixth Sense, and for example, direct to consumer. You see Pi Ventures, which is doing deep tech, or Special Invest in deep tech. There are some which are focusing more on fintech. There are some that have come in SaaS, like an Avatar, Together, many others. I think what has happened is that if you look at this new reality, founders are coming with a much deeper background. These are what I would call the Gen 2 founders. Yeah. They have been part of a startup journey. I'll take an example. We have a company called Buyer Assist in our portfolio. 3 people, they all were part of Mindtickle, which is now a unicorn, but these 3 were very early people. When they're starting a new company, they're pretty savvy guys. They've seen one full journey of SaaS. When they talk to VCs, they don't want to be explaining the SaaS alphabet to a VC. The VCs better be very smart about SaaS in that situation. And therefore, VCs have to become a lot more specialized. They can't be treating conversations with entrepreneurs with a complete blank head. Right? Even though the funds may be generalist, but individuals within funds, I think, are becoming a lot more specialized today. Somebody will just do SaaS. Somebody will just do fintech. Somebody will just do D2C brands and e-commerce, right? And that's how people are structuring themselves. We are seeing a lot higher volume of deals. I'll just again give you numbers. Even when we started our fund in 2017, again, we were a very small entity. We were a startup ourselves. I think we saw 500 deals. This year, that's 4,000 deals. I'm talking 4,000 new deals. So that shows that the volume has gone up significantly. People are forced to focus. People are forced to have thesis. You need to know exactly the kinds of things that you're looking for, what sort of fits within your thesis in your evaluation framework. And that's where people go for today. But I think in all those ways, the business has evolved and matured. The VC ecosystem has evolved a lot and matured quite a bit, therefore.
So you may have already answered some of my next question, which was around building differentiators as a VC firm itself, right? I think you mentioned a few things, having a proper sector thesis, having that founder network, and so on. Is there anything else that you would like to add on that front?
Yeah, see, if you look at it, in a VC fund, there are only 2 things. Either your existing portfolio gives you the brand and the edge, or the people that you have give you the edge. We don't have any other assets, frankly, in any VC firm. Again, while we are fortunate to have some great portfolio companies, on the people side, at least we have, right from the time we started back in January 2017, we believe that we need to be in a specialist model. For example, I have only been doing SaaS. I've been doing SaaS for the last 9 years. I don't understand social media companies, or I don't understand D2C brands. But luckily, my colleague Rahul does. Similarly, Ritesh has been doing healthcare for the last 12, 13 years as well, right? So we believe that you need to be very specialized. We also believe that entrepreneurs expect a lot more from us in the value we can add. And there we do feel that an operating DNA matters. So we have highly skewed ourselves in operating DNA. If you look at our team, I would say broadly, there are 3 categories of people. Either those that have been in global tech companies and built large P&Ls. For example, Ritesh managed a global P&L for Adobe. I managed a $500 million P&L at SAP. Or we have people who have worked in a startup right from the ground up, like we have Arpit Maheshwari in our team. He was part of 2 startup journeys and in very senior capacities, managed large teams in those startups, right? Or we have people who are entrepreneurs themselves. So we have Mayank in our team who built a company called TalentPad in the past and then was in multiple startups thereafter, like Ola Financial Services and Credit. Similarly, we have Naman in our team who actually built hyperlocal services company in his past and then a D2C brand startup in his past. And we feel that that combination of entrepreneurial and other operating DNA is what allows us to, one, empathize better with entrepreneurs, allows us to give more realistic advice also to these founders. The third thing I talked about already is the value that we get from our founder network members. We actually never publicly talk about this anywhere, but if you begin to look at some of the best known entrepreneurs in the country, assume many of those are investors in us, and we work very deeply with. So to give you a perspective, 30 to 40% of our portfolio actually comes from recommendations from these people. They participate with us in diligence. We frequently exchange notes on thesis. We invest in the companies that they have invested in the past. They invest in companies directly also that we have invested in. There's a lot of exchange that we do with these people, but they're very tightly integrated. And we believe that that's a very significant edge that we bring. And the last thing is we are highly selective. We are highly thesis driven. We believe in a concentrated model. We don't make too many bets. The bets we make, we want to take significant equity and double up on those companies and stay long in those companies. So we believe that money is going to be made in concentration and not with a spray and pray model. Right. So every person, every partner will just usually make a couple of bets a year at best.
This episode is brought to you by Mulya. You want to move fast? Sure. But without breaking things? Now that's a hard ask. The thing is, once you have some base of users and customers, you just cannot afford to risk quality. So how do the likes of Cred, Swiggy and CureFit, some of India's fastest growing startups, ship at lightning pace and delight their users and customers? Simple, they're working with Mulya as a strategic quality partner. Mulya is India's most talented and passionate community of testers. They've helped prevent thousands of bugs and regression issues. So as a CTO or a product owner, if you want to reduce tech debt, especially while you scale, do check out Mulya.com. I've interviewed Mulya's founder and CEO Pradeep on the podcast earlier, and we spoke about how startups can improve quality while scaling and things to that effect. You should definitely check it out. I'll link to it in the description below. Now back to your regular programming. Right. It's hard to have that conviction, right? When there is so much of FOMO in the market. I mean, you may miss out, and especially something with like a VC business where the tails matter so much, right? So yeah, I mean, that's amazing. I'd love to talk about some of the focus areas, things that you're most excited by. Sometimes when you look at the India market, it seems like a giant buffet, right? I mean, really, like every sector, every domain has so many things that are broken that tech can solve at scale, and there's so much of headroom for growth, right? But any specific areas that you are most excited by?
So Roshan, I can answer your question in 2 different ways. One, because I do SaaS in our team, I think I can talk probably more deeply about SaaS that I see, but I can also talk about what are the big trends we are seeing, which are not necessarily sector specific, but these different trends may combine to create certain kinds of opportunities. And let me take that first. I think number one, we are seeing a very significant increase in the pace of digitization. See, nobody ever doubted whether the world is going to digitize or not. It always was a case, was going to be. But the pace has changed because people are forced to. And I think that has led to a significant behavioral change in particular sectors. That includes healthcare, includes education, includes remote work, includes just the way people sell. People have become used to selling on phone or buying digitally compared to what it used to be in the past. Secondly, there has been an explosion of live video. I just gave you the example. We raised our entire fund without a single face-to-face meeting. It was not even thinkable, frankly. Even though we breathe and drink and eat technology all the time, we could not have imagined. It has also led to an enhancement in particularly computer vision capability across the globe. We're also seeing, Roshan, that we have seen the wave of Indian B2B companies going global. That has already been happening for the last decade. I think we are seeing that happen in the consumer tech companies. And I see that as a very, very exciting trend from India. I think India is also very unique in the way it has thought through its public financial infrastructure stack. Whether it's UPI, whether it's Aadhaar, we have been, I think, thinking through these things where in many countries, if you look at the PayPal of US, that was basically a completely private effort. In India, because of UPI, I think the infrastructure has evolved very different. And we believe that with the underlying standards being governed by the government, being made open, I think India's financial infrastructure is evolving actually at a very, very rapid pace now. The next being just the democratization of what we call AI/ML with massive data available. If you look at the amount of data, there is a Moore's law of data also. I think every 2 years, data is doubling, maybe even actually at a higher pace. And what was a fancy buzzword in the past, I think we are seeing real applications where that can be deployed today. And that's leading to very exciting kinds of businesses being created. And I'll give you a couple of examples of that. And the last part being that there's a transformation in the way we think about employment. I think gradually what we think of as a gig or a passion economy, where people do what they like and people do it at the time they like and people do it for the duration that they like, I think is changing very significantly. I was talking to, you would have heard of this, one of the senior executives of Genpact created Vivtera, which is, think of it as a new age BPO company. And again, I was with him over the weekend. They have 75,000 people who work with them as gig workers, all paid by the hour or by the job. No fixed employee in the company. Everything is technology in their company. So unlike these companies with 100,000, 200,000 people, that's how we have seen services company of the past being built. I think the new companies are being built without actually people, effectively. So think of the implications. Think of what happens to entire SaaS world the moment machine learning comes into picture. Imagine that you had a recruiting software. That recruiting software ultimately was basically classically a workflow. You send your resume, that resume goes here, it goes to 3 people, they filter, then they come, then you write to the prospect, right? Workflow. That's the classical model. Today, a lot of things that the humans did actually will be done by machine. The process needs to be rethought. Think about customer onboarding. We have a company called Signs in our portfolio. Even a very complex customer onboarding today can be completely digital, can be completely done by machine as well. And therefore, we believe that the entire SaaS world will be rethought in the next decade. So lots of those kinds of opportunities are coming in India. We are very excited, for example, about D2C brands that are directly targeting global customers. We have, for example, even a company in education in our portfolio called Allround. They are in the extracurricular space. By accident, they found out that a lot of their clientele actually ended up in the US. And that's where they are anchoring their growth today on. It was not thinkable just a few years. So I think a lot of those are examples of the new kinds of opportunities that we are finding in the market. So I don't know if that answers your question, Roshan.
Yeah, no, that does. I mean, I think you gave a fairly broad answer. I'm going to dig deeper on SaaS particularly because I think, you're passionate about SaaS and I work in SaaS as well. I think if you look at the SaaS startups of 7-8 years back, right? I'm talking about, let's say, a Whatfix or a Signsy or even a Waymo. Yeah. There's a marked difference between someone starting a SaaS startup today in 2020 or 2021 versus the others, right? I mean, one very apparent difference that I notice is that today people are not afraid to be global first. Earlier, I mean, it used to be India, Southeast Asia, maybe, Australia, and then the US or Europe. I mean, now people are sort of building for the US sitting out of here. And it makes a lot of sense as well, right? So what are some other things that you've noticed in the evolution of SaaS startups itself?
I'll pick off from where you left on this one, Roshan. It's one of my favorite topics also, which is you said people are not afraid to target the global markets right from the get-go. In fact, I would argue that we have seen both what you just said and in fact, just the reverse of it. And let me explain what I think. On one hand, the recipe of going global has become far better understood today. I remember that as an example, when I first started working with Whatfix, and I'll confess that I didn't know anything about SaaS either at that point in time. We were trying to figure out how do you build a pipeline digitally? How do you set up a remote inside sales? What's the largest deal size that you can go to when you're doing that remote sales? How do you speak to a customer when the customer is sitting in the US? All those things we didn't know. We were getting those answers by experimenting. Fast forward 8-9 years. Today, scores of companies, including your company, they have figured these recipes out, and therefore new entrepreneurs starting today, they don't have to go through the same learning cycle as these other companies had to go through in the past. And therefore, you're right that their ability and their boldness in going to US or other Western markets is very different today than what it used. On the flip side, if you remember, there was also a conventional wisdom that, look, India and Asia are not worth starting off with because you should just go global directly from day zero. That's what Freshworks did. That's what our portfolio company Slintel did. By the way, that is what WhatFix did as well. However, what has changed today is, Roshan, that if you look at the 0 to 1 journey or even the $0 to $5 million ARR journey, India actually earlier did not have cutting edge early adopters. Large corporates in India were never going to talk to startups and buy anything. And even if they bought, it'll take 12 months. Even if they buy you, they're not going to pay you upfront. Even if they pay you, they're going to pay you a tiny price, they're not going to pay you more. And even if they write the contract, you can keep collecting from them whatever you want to, and you will probably die before you collect. All that has changed. WhatFix today uses 100 plus SaaS packages itself. Every company I talk to, SaaS company in India, they have ChargeBee, they have Capillary, they have WhatFix, they have Mindtickle. All of them are their customers. And therefore, those early customers with which you can build the product, get to the first million, prove the product market fit, understand the go-to-market mechanism, all that is happening in India. So in many ways, at the starting point, there is enough critical mass of customers in India to go to be able to get to product market fit. I think so. Both has happened in my opinion. I think the other changes in the SaaS ecosystem is that 8-9 years back, there was a recipe. And the recipe was low price point, SMB centricity, remote sales, existing category, inbound motion. That's the recipe. That's how you build a SaaS company from it. Today, there are more flavors than you can count on your finger. There is vertical SaaS, there is regular SaaS. There is enterprise, in fact, you look at Vimo, such a great example of enterprise-centric SaaS. Vimo, WhatFix, Mindtickle, I can take iCertis, so many examples of enterprise-centric SaaS, and yet there are lots of companies which are still targeting SMB. So frankly, in our portfolio, Slintel was in the SMB side. ScienceZ is in the, if I think about ScienceZ, their average revenue per customer is $500,000 plus. So there is no single flavor today that Indian SaaS has. It actually cuts across, right? A lot of investor interest. It was very hard to convince a Silicon Valley investor to come into Indian SaaS company. In fact, you guys were among the pioneers in many ways, I think, with emergence coming into Vimo. But the number of calls I get from Silicon Valley VCs is not funny. Everybody wanting to know what's happening in Indian SaaS. Everybody wanting to know our portfolio, people wanting to jump ahead of themselves to talk to these founders. So that investor interest has gone up significantly. We are seeing very aggressive multiples clearly, but that is also because the public market multiples have gone up significantly for SaaS. A lot of second-time founders and experienced mentors. So I think significant change. I also remember, Roshan, that when I started as a SaaS investor, I could count on fingers of a single hand, frankly, not even that many, who I could call the SaaS investors in India. Today, even if I start counting my hair, I think they will not be enough for the number of SaaS investors in this country.
No, SaaS has suddenly become so...
No fund. Yeah. There is no fund in the country that is not writing SaaS checks.
Yeah. No, it's so lucrative, right? I mean, the unit economics and everything, really the playbook, the metrics, everything makes a lot of sense. And, I can probably, you might also recollect about, 10 or 15 years back, I mean, people would begrudgingly say that, hey, we're just doing all of this services work. Where is the IP? And there used to be that common trope, right? But then, I think it has led up to this, right? Because if you look at, some of the vertical SaaS or industry cloud solutions that are being built right now, this is also being built by folks who have spent let's say, 8 years or 10 years in banking, for instance, or in healthcare and so on, right? So,
Indeed.
Yeah. So what do you think about, the whole metric or playbook or benchmark driven mechanism of SaaS? Because sometimes it scares me, because there's literally a precedence for everything. So sometimes I feel that, maybe we're trying to engineer product market fit, maybe a 3x, 2x, or whatever else is probably not something that you can force fit to every startup, right? I mean, I can speak of very enterprise solutions, which really take longer, right? Obviously the sales cycles are longer, and there's a lot more discovery, and what you may solve for 5 customers may not be relevant for 50 customers and so on. There's so many nuances to it, but just a open thought.
Roshan, your perspective is sort of bang on the target here, because there are so many different flavors of SaaS from India as well. There can't be a unique recipe, there can't be a unique benchmark. And if you think about that, that benchmark can be for very, very many different metrics. What you talked about was growth, right?
Yeah.
Once you hit $1 million, then you grow 3x, 3x, 2x, 2x. That was the conventional. All I can say is that the benchmark for growth has gone up from it. Even for the same thing, I would be happy if $1 million became $2 million ARR next year. I'm no longer happy. Best companies do 4x, 5x. At the same time, you can't blindly apply these numbers. As you correctly said, if you're a large enterprise-centric company, then your initial growth might actually be slower. It takes a long time to enter the new accounts, and you typically enter with still smaller tickets there. Right. And you land and expand gradually. So therefore, it might be a very different thing in a large enterprise SaaS, might be very different in SMB. So there are these differences in numbers, but the benchmark, at least I can say at an aggregate level, the benchmark has gone. Similarly, when you begin to look at benchmarks for what does a good NRR mean, which is the net retention rate, at least in enterprise companies, we are finding that that benchmark has also moved up gradually, right? We used to be very happy with 110, 120%.
Yeah.
I think great SaaS companies should do 150%.
Exactly.
180% also. Yeah. I mean, if I take SignZ, you can't even calculate the number because bulk of their revenue comes from these very large customers who write very large checks in later as well. So I think many of those benchmarks, in my opinion, have changed fairly significantly. On the other hand, if I take an open source kind of a company, that curve is very different. They might not even have a revenue until they reach Series B. So yeah, I guess it just varies significantly across these. But the bar has gone up for sure, Roshan, compared to what it used to be.
So the SaaS ecosystem was also developed by leaps and bounds, right? I mean, in so many ways, Freshworks has kind of broken the glass ceiling now. And we will see plenty of others like sort of follow the same, path as well, right? In terms of the ecosystem itself, like when you talk to people today in SaaS, I mean, when you talk to operators or founders or whatever, what are some 2 or 3 things that you notice that are different with these folks? We had smart people all the while, but I think there's a little more of a precedence right now, I would say, right?
Well, I think for one, there are many more role models to look up to. When Girish started, there weren't that many role models that Girish had to look up to. Of course, he had maybe Sridhar of Zoho, but probably that's as far as he could go at that point. Today, there are a lot more examples. There are many more mentors available, I think, to people as they start up. I also think that if I view the same thing from a VC perspective, I'll again confess to you, Roshan, 9 years back, I remember my first SaaS deal. And my conjecture at that point was that when I did my first one, that if I really dream big, the exit size can be $100 million. I know you will laugh at this today. I laugh at it.
But I completely understand because right? I think the hottest startup of that time was Redbus and it sold for about 100, 120, right?
I could not dream bigger, number one. Yeah. Number two, even if I were to dream of it and if I were to tell my partnership, they'll say, are you out of your mind? Right? Yeah. So we underwrote at 100 million exit size. That's how we underwrote. When we started Stellaris and I wrote the check in Whatfix, we underwrote a $500 million outcome as a possible exit. And we did our math basis that. Well, they're already ahead of it already. And today, I think it's going to be a multi-billion-dollar outcome for sure. Yeah. Right? So now that when we are writing seed checks or Series A checks, what can be the possible outcome? That lens has changed quite significantly for us. And that changes the way we deploy capital in these companies also. So in many of these ways, I believe that quite a few things have changed.
Right. So that's a very interesting thought, right? So how has that affected the way you evaluate startups right now? Has your framework changed because of that?
Well, the fundamentals have not changed, Roshan. We are always looking for, since we come very early, we come into startups when mostly those spaces don't even exist. That's our starting point. But we are still trying to look for attractiveness of the macro market. We don't look at it in a very micro way because we know that path may change from here to here, etc. Including Vaymo, from what I met the first time to what the business is today, things have changed considerably. That's the way startups get built. Right. So we take a macro view. And we spend a bulk of our time evaluating the founders. We are trying to figure out, is there a particular edge that this founder brings to the table? We don't have, by the way, any predefined notion of what that edge needs to be. There is no unique template to be a great entrepreneur. They all come in different forms. In fact, I feel that every great entrepreneur defines a new template for a good founder also. So our job is to figure out what that edge is in that founder. So those fundamentals, I would argue, have not changed. What has changed is that when we're evaluating, however, the bar for what constitutes good execution has certainly changed. Particularly if I'm writing a Series A check, there is some execution track record until that point. And what constitutes a strong execution team has certainly changed on that front. Similarly, as I said, that when we are writing checks, our notion of how large it can be has also changed. there. And how, therefore, the company needs to capitalize has changed. If I think about Slintel, for example, we came in, we were the first investor in Slintel. But very soon we did another round. We got Axel in, we got Sequoia in, then we got GGV into the company as well. And we did that because we knew that here is an entrepreneur that can run really fast and become really big very quickly. And therefore, the way you think about capitalization also changes in many of these.
Right. So, when you look back at the last couple of years, right, I think in March, April time, I mean, I especially remember the Sequoia blog, and, it was spine chilling almost, right? And everyone got this jolt, but there was a lot of doom, and for good reason as well. But when you look at the last couple of years, how do you think we have managed? I mean, what are some things that you got right, and what are some things that you completely missed and that completely surprised you? It could be about your own experience, or, I mean, the experience of your portfolio startups.
I think, first of all, we ourselves did not expect the level of tailwind that COVID will provide. Even though we knew that it is going to help technology, I don't think we anticipated how far it will help. And I think even with our own portfolio companies, Roshan, I'll confess that we were being very cautious with them and the way they were spending money. We were not sure that if you flip a coin, which way it's going to land still, whether the capital will completely dry for it. So I think that was one area where I think we misread the direction of the market at that point in time. In particular, I did not imagine SaaS markets from India to evolve so rapidly. And I think a lot of things came together. Yeah. There was a time when nobody believed in India SaaS, but suddenly there is a Freshworks, there is of course a Zoho, there is an iCertis, there is a Postman, there is a Dhruva, all of them becoming big, Capillary, Whatfix, Mindtickle, and the fact that the capital availability, the kinds of entrepreneurs will evolve so rapidly, I think we didn't see ourselves. Though I think we have been lucky to back some great entrepreneurs in this process as well. But I don't think that we had anticipated things to happen that quickly. That being said, we all maintain our anti-portfolio all the time. If I go back, for example, I missed Mindtickle. I evaluated multiple times. Right. And I'm going back to 2013, 2014. I missed ChargeBee. I evaluated multiple times again, Roshan. I evaluated Vimo. I missed that too, right? Lots of these great companies I didn't back. It's very hard to say what is it that we have missed in the last 2 years, because I will get to know that answer only 4 years later when these companies become bigger. But there is no doubt about the fact that the number of misses in the last 2 years will be far greater than my misses 8 or 9 years back, because the sheer volume and quality has gone up significantly. Yeah. And that's just bound to happen.
Right. So, Alok, finally, what would your 3-point advice be for young entrepreneurs who are listening to this podcast? How should they build successful, sustainable businesses going into the future?
So 2-3 things that come to my mind. Number one is that don't get overly swayed by the environment also. Sometimes you can begin to drink your own Kool-Aid too far. As I mentioned earlier, it's a great time to raise capital, but be careful in how you spend that capital. There is, in every year, there is a summer, but there is also a rainy season. There is also a winter. It is going to happen, whether you like it or not. And make sure that you are planning those scenarios as you spend your capital. Number one. Number two, build what you want to build. Don't build for funding. Don't build for investors. Don't think about what is a new hot thing that you need to show to investors. It takes a while to build a company. There'll be some bull cycle. There'll be some bear cycle. Ultimately, you have to back your vision. You have to back your own gut, and you have to listen to yourself in that process. Also, I think that don't forget the fundamentals of building a company. Every company requires achieving a product market fit. It still requires having a strong unit economics. Even though the world may believe that economics doesn't matter today, they will care about it tomorrow. It is also important though, however, once you find a product market fit and you find a unit economics that works, you are pushing the pedal very hard on the gas and scaling very rapidly. Lastly, I have to say that the one thing which I think that matters the most and differentiates great companies from good companies is how rapidly they can evolve their organizations. Ultimately, a CEO's job is not to build product. CEO's job is not going to be able to sell. They've done that. They did that while they were in Series A, maybe in Series B at best. Their only job thereafter is, can they rapidly evolve the organization for the future? And I think despite being very good entrepreneurs, many of the people are not able to, and I think that's where they need to pay focus.
No, for sure. I think that last point really hit home, because nowadays when I talk to startups, right, I think the quality of the leadership team, if anything, is a very good marker for success, right? Because in some sense, I mean, the founder has been able to sort of hedge themselves against one function or multiple functions. right? Which means that, I mean, they have that much more time and energy to actually think ahead. So yeah.
My belief is that with every new round, and if you think of a round as a 2-year cycle, half your management team needs to change.
Right.
And that's very hard to do for founders, but half your management team needs to change every 2 years as you're building a company.
Right. So Alok, this has been a fun conversation. Plenty of insights in here that I will be reflecting upon. Before we leave you, any books or podcasts that you would recommend?
So let's begin with the podcast first. I actually listen to podcasts when I run in the morning, and there are only very few that I listen to. I don't know if you can see my screen.
Yes, sort of. Okay, Tim Ferriss. Okay, Startup Operator.
Right. So
Right.
You will see the Startup Operator. You will see Invest Like the Best.
Awesome.
20 Minutes VC, A16Z. These are some of my favorite podcasts that I listen to, and I listen to at least 2 podcasts every week. That's sort of my pace of listening to podcast. As far as books are concerned, I like historical fiction. That's what I read. So books that are set in a particular time of history, but set as a fiction.
Right.
It still gives me a lot to read, and some non-fiction as well. I think from this year, if I think about the recent ones, I read Bill Bryson's Short History of Nearly Everything.
Oh, it's a fantastic book.
Absolutely fascinating.
Amazing book.
I'm currently reading Pachinko, which is, a lot has been written about World War II as it relates to the West. Hardly anything has been written on what happened to a China, a Korea, a Japan in that same thing. So this is set in the Korean peninsula. I also read about, again, for example, even in World War II, a lot was written about Germany, England, US. But I read a book called Shadow of the Winds, which actually talks about the World War I and World War II journey as it happened in Spain. Hardly any of us talk about Spanish history as it relates to World War II or World War I. But again, those are examples of the books I read recently. I don't read, by the way, as much as Pooja does. So Pooja reads about 40, 50 books every year.
Wow.
I read about 10 books every year.
Right. Fantastic. That's a great note to end the podcast on, Alok. This has been fun. Thank you so much again for making the time, and all the best for everything that you have coming up.
Thank you so much, Roshan. I really appreciate your getting me here as a guest. Really enjoyed the conversation as well.
Thank you so much for listening. If you liked this episode, then don't forget to subscribe to us on your favorite platform and share this episode with all of your fellow startup operators. Also, follow the Startup Operator on LinkedIn and Twitter for more updates. Stay safe, take care, and see you soon on a brand new episode of the Startup Operator.